Hey everyone, this is Chris at Cryptocurrent, and in today's video I'm going to be going over the basics of technical analysis along with some of the most used indicators when trading and analyzing price action. Technical analysis is not restricted to cryptocurrencies only, as you all probably know. You can also use technical analysis on real estate markets, on the commodities markets, on equities, the stock market. So it is a very useful tool to have if you are considering investing or analyzing any type of charts. So, just first of all, to get the basics out of the way, right here on the screen I'm going to be putting up a little chart, and I'm also going to be linking it down in the description, or this little picture, on the basic chart patterns and definition of what a candlestick is, right? So a candlestick is each individual bar, right? What that means, how to read it. And then on top of that, I'm going to be linking or putting right here on the screen a little list or document with all the most common trading patterns that people come across when trading. So first off, let's talk about supports and resistances. So all support is a general price area where the price of whatever you're trading or whichever asset you're looking at is likely to bounce off of. You can think of it like a trampoline almost. And then a resistance is a point that the asset has a very hard time getting above. So we know for Bitcoin, for the past couple of years, a really big resistance level was 20,000, right? Because that was our top, and we had a really hard time coming above it. Here I'm going to be going over how supports and resistances kind of play out during market cycles. Right now I'm looking at the 2017 bull run because here's a really good example of supports and resistances, not only how they act, but also how they change with time. So in this bullish impulse here, we saw that Bitcoin came up to around $3,000. $3,000 was a pretty big resistance area, and it held us down for several months. However, once we broke above this little price area, right? Once we broke above it, the price came back down and tested it. And it couldn't go lower than that, right? So this support turned into a resistance. So we know that when analyzing charts, support can become resistance, and then resistance can become support. And supports and resistances don't necessarily have to be horizontal lines as I've just drawn it here. There's other types of supports and resistances you can look at. You can look at trending ones, ones that are on an angle. You can draw them like this. So we saw that here. This is just a very rough drawing and an example. That here we had a general uptrend, right? That we touched once, twice here, 3 times here, and once we broke below this support, even though it was trending upwards, it was a support line. We continued down into the bear market. So that could be another way of looking at supports and resistances. So we know that supports and resistances play a very important role. They play the role of being the floor or the ceiling of price action. And we know that once you go through the ceiling, you can go to the sky. And if you break the floor, you might end up going down to hell, right? So they're like two zones that we always need to be keeping in mind. If we want to predict or know where the price might be going in the near term or long term. Next up, I'm going to be going over the 5 most common indicators people use. This is just a beginner video / intermediate, so I'm not going to be going over the more complicated ones I use in my charting, but just the 5 most common ones you should get really familiar with before trading any cryptos. So the first one is called the MACD, and you can go ahead and search it up right here on TradingView, and I'm pretty sure all exchanges have it. So here I have my MACD indicator up, and the MACD kind of tells us whether or not we're trending upwards or trending downwards, and you can use it to determine when you want to buy or sell. So if you notice that the MACD has gone bullish, which means that the MACD is, I'm going to make it bigger so you guys can see here. So when you see that the MACD goes bullish, which means that the blue line, in this case, is above the orange line or the yellow line, that would be a buy signal. That would be a good signal to be in the market. And when the blue line crosses below the orange line, that would be a big sell signal. And if we go ahead and look at the chart and kind of compare the two, we can see that, this could be a pretty good way of gauging when to buy and sell, during markets. Here we saw a MACD cross to the upside. And, the subsequent rally went from, 1,000, 2,000 all the way to 20,000. And then over here, we had a MACD cross, right? We had the blue go under the orange. And that was when Bitcoin was $12,000. So if you traded purely off the MACD here, you would have entered a trade down here at $1,000, and you would have exited up here at $12,000. And that's a fantastic trade. So in a lot of cases, the MACD can be very useful, when you're gauging the trend of the market, whether it's going up or down. One of the second more commonly used indicators that I'm going to pull up here is called the Bollinger Bands, which measure so the MACD kind of measured how the market's trending, and whether or not it's going to keep going up or start going down. And this other indicator called the Bollinger Bands, they tell us, they let us visualize what the volatility in the market's looking like. So here I have the Bollinger Bands on Bitcoin on the daily chart. And we can see that it's kind of like a little cloud that surrounds the price, right? And the way we can use this, we can use it in two ways, really. The first way is noticing whether or not something is overbought or oversold. So the red line in the middle here is the mean, right? The price always regresses to the mean. It's one of the averages. So sometimes when the coin or any asset goes far out of the little cloud, that would be a selling indication, right? It would be signaling that we're overbought, right? And we return to the mean, which in this case, for example, we did. And the same thing goes for the downside. If we pop out of the cloud, of this little, cloud we have around the price, that means we're oversold and we need to return to the mean. So you could, in theory, use this indicator to trade, for example, all right, if we go below it, buy, and if we go above it, sell. And, it works a lot of the time. No single indicator is going to work 100% of the time, but the goal is to use several indicators so you get a really good idea as to how the markets are looking and when and where to exit a trade. Another thing that we can use the Bollinger Band is, firstly we have checking if something's overbought or oversold, and secondly, it's the volatility, right? So here, for example, we saw that the price was way up here, but the cloud extended all the way down here, which means that at this point in time, Bitcoin was incredibly volatile. Same goes, with these regions, it was showing extreme volatility. These regions, extreme volatility. However, if we kind of look into, later into this bear market we had in 2018, 2019, we saw that this cloud, over time started getting smaller and smaller and smaller, and it started squeezing and coiling into this point where it was really, really thin compared to the past. And what this could indicate is that we're going to have a big breakout, I guess, right? Which means think of it kind of like a spring, right? So if you're pressing a spring together, if you press it for long enough, eventually it's gonna release all this energy, and it's gonna either go shooting up or shooting down. So you can think of the Bollinger Bands kind of like this. Once it starts coiling in and getting really small, it's like you're pressing the spring together, and it's gonna have to pop, either up or down. So that's a good way to be able to trade volatility. If you see an asset that's really, low on the volatility with a squeezing Bollinger Band, then you could, position yourself to say, okay, if it drops below this level, then I'll go ahead and open a short. If it goes above this level, I'll open a long, etc. The next indicator is volume, which is a pretty straightforward one. It's these bars down here that represent how much of the asset has been traded in the past 24 hours in this case, or whichever time frame you're in. Right now I'm on the daily. So here we could see, on this specific day, February 6th of 2018, there was a lot of buying that went on. That's why this little bar here is super tall. So we know, okay, so there's a lot of buyers coming in. Same with this bar over here, we saw that there was a lot of selling, right? So, I guess we could perhaps interpret this huge candle as a warning sign of a lot of people exiting the market, you know. And I guess in this case it would have been correct to interpret it that way, you know, thinking, okay, a lot of people are selling here, so I think, you know, the markets are going to turn directions, and, you know, the markets did. So that's volume, more or less. And typically when we're looking for reversals in price action, so that be in, you know, from the price going, you know, from lows to highs or from highs to lows, we want to see volume follow through to like kind of to confirm our predictions or our hypotheses. Here, for example, on this day, there was a lot of selling compared to all the previous days, right? It was the most selling that happened on a day for maybe a year or so. So that could be a good indication that the markets are going to be going lower, and, you know, subsequently they did. They kept dropping all the way down to 3,000. So that's kind of the volume, and it's important to realize that volume is just another way of saying, you know, X amount of people are buying. So if the volume is very high, that means a lot of people are buying or selling or both. And if there's very low volume, that means not many people are buying or selling or both. Typically on weekends, there's a lot less volume because most traders, you know, operate on from Monday to Friday. But since crypto is a 24-hour market, we can have volume spikes on any day. Next up, we have the RSI, which is what it stands for, the relative strength index, which is just a way of measuring how overbought or oversold the current market is. Typically, from my experience, the RSI works best on longer time frames, because on shorter time frames, Bitcoin and just cryptocurrencies in general often disregard the RSI when it's flashing extreme overbought or oversold conditions. I mean, just look here. I'm going to give you an example of the past couple of weeks. Bitcoin has been, you know, with an RSI of over 80 for a couple months now, which in traditional markets would be completely out of this world, but in crypto that's just, you know, a normal thing. So really the way I would look at RSI would be anything above 80 in crypto would be considered overbought. Anything below 30 would be considered oversold. So yeah, that's pretty much it for the RSI. You can use it on smaller time frames, but it's not as useful in my experience. I like to use it on longer time frames. I get a little more data, and it's a little more responsive to the overbought and oversold conditions. And now finally I'm going to be going over the moving averages, right? So the moving average is just an indicator that takes in whichever parameter you give it and then averages those amount of days. So you can have a 10-day moving average, which averages the last 10 days worth of price action. You can have a 20-day moving average that averages the past 20 days of price action. Here I'm going to go ahead and put just, probably it's going to show me a 9-day moving average, yeah. So the 9-day moving average here is also another way to determine supports and resistances. And again, this moving average works better on longer term time frames, right? So I wouldn't really be using moving averages on anything lower than 4 hours. I feel like they're just pretty inconsistent with determining support levels. But that's really what the moving average is. It's a tool that helps us determine supports. Here, if I put it on the 20 week, right, the 20-week moving average, we can see that it is really consistent with holding up bull markets, right? So we can see here that the price consistently held above this 20-week moving average. Here as well, it more or less held above it, and then continuing this huge rally we had in 2017, it's held 4 or 5, several times. Once we breached below it, it was kind of official that we entered this bear market. So now a lot of people have their eyes on this exact same 20-week moving average mark, which currently is sitting at around 20,000. So dropping below 20,000 at this point would, and closing on a weekly time frame, would be pretty bad news, but that's far off from here, so we don't need to worry about that for now. Anyways, so those are my top 5 indicators that you should learn, whether you're beginner, intermediate, trading in crypto, forex, stocks, whatever. It's the MACD, which is you wanna buy into something when the blue crosses above the orange, and then sell when the blue crosses under the orange. And then the Bollinger Bands, which measure volatility, right? And also overbought and oversold conditions. We have the RSI, which is strictly for overbought and oversold conditions. We have the moving averages as well, which can tell us support and resistance lines. And then we have the volume, which is a pretty useful tool as well. So with those 5 indicators and being able to determine supports and resistances, you should be pretty set with navigating your way through some trades and hopefully being profitable. Anyways, I hope you learned a little bit with this video. Give it a like if you enjoyed it, I guess, and I'll see you guys next time.